Hello, my name's Catherine and I will be your financial advisor for today and hopefully for the foreseeable future, as long as you're happy with how everything goes. Okay, so I have my notes here. I think you're in for investing and sort of learning about investment and how to grow your wealth. I think we have you scheduled for 3 appointments. Okay, you're going to see how this one goes, that's fair enough. So let's just dive right in. What are your goals with regards to investing? Is it just a case of you want to put your money somewhere to grow, or are you interested in making it a career or a side hustle, sort of day trading, that sort of thing? Put it there and leave it more the first one. Yeah, that's the smarter decision in my opinion, and it allows you to do more with life because you can just leave your money to it and let it grow. That's the best thing you can do. I think the more you fiddle with your money actually and your investments, the worse off you tend to do in general. You've just got to leave it there. Okay, that's good. So I have to start off with an intrusive question, just so we have it for the record, so that we know the amount of money we're working with here. Can you tell me your annual income? Okay. And did you bring in the list of your outgoing regular expenses like we asked you to prepare? Okay, thank you, that's great. I can't tell you the amount of people who come in here and we've asked them because we just want to help get people's finances in order as quickly and as cheaply as possible for them, and then they don't bring something as vital as that. So okay, so your yearly income divided by 12, and then we take those outgoing expenses, and okay, so it looks like that's taking up about 50% of your income, those big regular expenses. That's good, that's very healthy financially. So what we tend to advise is that we split the remaining, what you have left, we split that money into 3 categories, and of that remaining amount, we'll split it into 50% for discretionary spending. You can alter these, this is just a guideline. So when I'm talking about discretionary spending, I'm talking about fun purchases, stuff like that, but I'm also talking about smaller expenses or unexpected expenses that just come up in life. So that is going to account for 50%. That's for you to do what you like with throughout the month. And then we're going to split the remaining 50% into 20 and 30. So the 20% we would advise you to save, and the 30% we would encourage you to invest. So that's a sizable chunk of your income each month. In terms of the actual monetary value, and of course if you already have, a large emergency savings pot, then we would encourage you to invest more than the 30% remaining of your free income, so to speak, the income that's not accounted for. So you could up it to saving 10% of that remaining amount, or even 5% if you're completely sorted when it comes to savings, and choosing to invest the rest. It's really all to do with your personal goals and how much you already have saved. Okay, so that gives you an idea of how much you should invest each month. And do you have an initial sum ready to invest immediately? Because that can be really helpful in just starting off the wealth accumulating tool that is compound interest. It's always better to start with a large sum than to not, but if you don't have it, that's completely fine. Regardless, you're going to be benefited. Oh, you do have an initial sum, that's great. How much have you decided to invest initially? Okay. Okay, great, that's a very healthy sum. We're going to get some great returns out of that. So the last thing I'll say about the proportion worth spending and saving is just to make sure, and you'll have heard this plenty of times, but pay yourself first on your payday. Make sure that you put the percentage that you've decided on into your savings account and then move on to investing and do it on the same day. And then it's just out of the way and you don't have to think about it for a month. Okay, so the next thing I think we'll discuss is have you heard of the phrase risk tolerance before? Do you know what it means? You have an idea? Okay. Well, I'll just quickly go over what it means, just, to clarify. So if you have a high risk tolerance when it comes to investing, then that means that you are willing to potentially lose a lot for the possibility of getting very high returns. And then a low risk tolerance would mean that you're prepared to essentially garner no risk. I mean, there's always risk when it comes to any sort of investing, but you're prepared to deal with the absolute minimal risk. If you have a low risk tolerance, but that also it limits your potential earnings. You'll never become a millionaire from having a very low risk tolerance, but for some people that's what they want to do. They just want to experience a tiny bit of growth of their money. They just don't want it to sit in a savings account, which is completely understandable. Although that is also a form of investing technically, and it's a form of low risk investing too. So given that information, where would you say that your risk tolerance sits? Okay, like a mid-risk tolerance. I like that for you. I'm very comfortable with that, and I think for most people that's a suitable goal, unless, for example, I would suggest that people saving for immediate goals would opt for a low risk investment portfolio, like mainly bonds, for example. But since you're looking at long-term wealth, you can't really go wrong with a mix of things. So even with medium risk portfolios, we work to mitigate that risk as much as we possibly can, because we want our clients to get the best out of what they invest. I didn't mean to rhyme. Anyway, from medium risk portfolio, we'd be looking at a mixture of stocks, bonds, funds. Also, if you started to accumulate more wealth in the future, real estate and art are also very prominent asset classes which you can use to diversify your portfolio and mitigate risk, but I'll talk more about that in a second. I'm getting ahead of myself, so I know you're probably completely aware of what these three things are, but it's even confusing sometimes for people in the industry because they're slightly similar. So just remind you, stocks are shares or equity in a company, and you pay a certain amount and you receive a certain percentage of that company, is essentially the basics. And then when the company's value goes up, the value of your stock also increases, and that's how you make money, because after 10 years in general the stock market increases in value by around 7%. So way down the line you'll be selling your share for a lot more than you paid for it. Generally, not always. Sometimes companies collapse, sometimes they go from being incredibly overvalued to, crashing down, and that's why they are quite high risk but also very high reward. And also I would say that some stocks are quite low risk in themselves. There are certain companies which are very, very large, which don't have the greatest growth in terms of they can't really grow much faster because they're kind of at the top of their game, but they're still worth investing in, just because that growth is a bit more reliable, even if it isn't as quick as some unicorn startup. So the next one is bonds, and it took me a while for me to get my head around this when I was training, but basically the layman's explanation of it, because I'm not the greatest well of knowledge on this, but essentially what it is an individual buys a bond, and it's essentially a loan which you usually give to the government. So you buy the bond for a certain amount, it's a loan to the government, usually can be a corporate entity, but usually they're government bonds, and during the time that you have that bond for, because bonds exist for a certain period of time, for example up to 2 years or 5 years or even 10 years, during that time the government has to pay interest, and usually this is each month, and you can receive that as income basically every month, and no matter what, the government or corporate entity has to repay the original value of the bond. So they are very low risk, they're almost certain to give you a profit, but obviously it's usually slightly less rewarding long term than some higher risk stocks, but depending on when you buy them, and this is a whole other topic which I won't get into now, but depending on when you buy them, and you can also sell them, it can actually be very lucrative, but that's a dangerous game and we're not going to play in that game. That game is not for us. So to summarise, even though I was rambling just then, you buy the bond for a certain period of time. Over the course of months of the bond's lifetime, you get paid the interest on that bond, and then you get repaid the bond's full amount, and that is how that works. So the last asset class that I'm recommending to you today, which we will integrate into your portfolio, are funds. And there are a few different types of funds. I mainly work with ETFs, which are exchange traded funds, and index funds, which track the success basically of a collection of companies, as shown in an index, like I'm sure you know of the S&P 500. It's basically just a giant list of all of the US's biggest companies basically, and there are funds that track indexes like this. So when you buy one of these funds, you're not actually buying the shares themselves, but it's as though you are, financially speaking. It that index goes up, your fund also goes up, the fund that is tracking that index. There are lots of different indexes, and there are lots of different funds that track different indexes. And what this does is that it means that the success of the fund is dependent on many, many different companies, which means that if one company depreciates in value, the other companies in the fund typically make up for it, unless the entire economy is shot. But in general, we're trying to protect you from kind of individual issues rather than entire stock market collapse, because that would be bad for everyone, but typically it always recovers. So we always say to our clients, if the stock market collapses, just leave it in there, and it will return eventually, because the stock market always recovers eventually. But lots of people get very cold feet, and as soon as they see everything falling, they sell all of their shares, and they can't enjoy the long-term growth that comes with having investments for a long time. But I digress. I am not sure whether I have explained funds too well, but I will talk about the last type of fund that we're going to get into today, because it is slightly different, and these are mutual funds, and these actually are buying the shares of these companies in these indexes. But obviously these companies are very large, very successful, the shares are very expensive. So what happens in mutual funds is that the investment bank itself usually buys them, and then individuals will purchase a percentage of the fund. So it's like they're purchasing a percentage of each company in that index, but they are actually buying the shares. Whereas, as I said, in index funds and ETFs, it's more like you're purchasing a promise. I didn't mean for that to get poetic, but you've got to take license where you can to be poetic in the financial industry, because the opportunity doesn't come along that often. So yes, we're going to get you a mixture of individual stocks, so buying shares in individual companies, and bonds, so you can earn money every month, and that can be really helpful. And we'll get you some funds, because that helps you protect your overall portfolio from, if one of your stocks gets hit, your funds or different stocks that you have can prevent your portfolio overall going into decline. And this investing across different asset classes is called portfolio diversification, and as I've said, it's all about mitigating the risk of one stock doing badly, or one sector or industry doing badly in terms of a sector or an industry specific fund, which can happen. It's all about trying to make sure that all of your eggs aren't in one basket. And another way that we can do this, as I've just kind of touched on there, is by choosing our stocks from different industries, different sectors. Another way you can improve your diversification is by buying stocks and funds which focus on different countries. For example, you might have stocks from the US, the UK, Australia, Germany. You might have index funds which focus on Asia, or you might have an index fund which focuses on a specific industry with a lot of global companies within it. So that can be just really great to mitigate your risk altogether, and for the vast majority of our clients, So I've spoken at you for a while there. I should ask you, are there any asset classes you're more interested in than others? Are you interested in bonds? Okay. And stocks? Okay. And funds? Good. We like that. The more asset classes, the better, as I said. And you have preferences of sectors or industries you like to invest in? Well, for example, some people have an ethical kind of conflict about investing in things such as oil, for example. So they prefer not to invest in that because they don't want to support it. I was just wondering if you have anything like that we should take into account. Okay. Yeah, that's completely fine. We will focus on companies and indexes which prioritize ESG. So ESG is environmental and social governance, and it basically, if a company or a particular index adheres highly to ESG, then they tend to have stronger morals and more ethical priorities, as well as the priority of profit. So we'll look for some of those for you. Yep. Okay, I can tell you've thought a lot about this. Okay, now there are a few ways you can invest other than the one I mentioned earlier, putting the initial sum in and then putting in a set amount each month on the first of the month or just your payday. That is what I'd recommend to you, because you said you wanted it to take up as little of your time and headspace as possible. But if you'd like me to go over other methods of investing, I don't know how else to describe it, I'll be happy to do that in another appointment. Okay, and as I mentioned before, we can always scale up or scale down the payments you make each month. I tend to recommend that if your income goes up, you scale it accordingly if your expenses stay the same. So we will make up a few hypothetical portfolios for you, and we'll show you them at our next meeting, and you can tell us which one you're happiest with, and you can recommend any changes if you're not happy with anything. And so I think the last thing we'll do, just to keep you interested in investing, because I can't say how many people we see and then we never see them again, and it's just the sooner you start, the better. So I will just do a few calculations with you so that you can see what investing can do for you over time. So we are going to aim for a 6% to 11% return for you. Obviously we will aim towards the higher end of that, but we can't really predict fully what's going to happen over however many years you keep your money in there for. But I will assume the lowest end of that range, just so that you can see how beneficial investing can be, even if you get a lower end of return than we predict. So 6%, and if we invest 5,000 to begin with and $500 for 20 years. So if we do that, you'll have contributed 120,000 overall, and your return will be 118,858. You'll have almost double the amount you put in over 20 years. So investing is very much worth doing, even if you get the lowest result that we predict. So with that in mind, think over all that we've spoken about today, and we'll talk more at our next appointment about the different brokers, companies, platforms you can use to invest. We'll go over the hypothetical portfolios, and you can choose which one is most appealing to you. And we can also talk about the other methods of investing, in terms of, I've mentioned pretty much the simplest one of just, as soon as it's your payday, putting in a set amount each month, but there are a few ways that people choose to do that, so I can just make you aware of them. I would still recommend this one, but it's good to have as much knowledge as possible in the financial world, in my opinion. So it was really, really good to meet you. I really look forward